Hey everybody, this is Luke Ding, COO of Brown Shoe Company, and today we will be doing our annual investor call. I'm going to start by talking about our initial strategy and how it worked out. Then DeRoy Simmons, our CEO, is going to come and talk about the competitive landscape and successes and failures of our strategy. Next, Minwon Kim, our CFO, is going to talk about coordination problems and biases. And finally, Andrew Barford, CMO, is going to talk about strategic pivot points and what we would have done differently. Okay, so our initial strategy was to find as much white space as possible on the SQ and models graph that was very pervasive throughout the entire simulation. In a little bit of game theory manipulation, we kind of expected everybody to go for that Walmart strategy. And so, we thought that there were two viable strategies, the Walmart one, which we expected most people to do, and then moving up towards the high SQ, high end of the price range. And so we tried our best to move up in SQ and price and models all at once. I think our ideal end game was to be in that top right corner. We called ourselves kind of a golden company in trying to do everything really well. And I think for the most part, it worked out. The immediate first round, we went up in SQ and up in price, but we did not go up in model because it was a little bit too expensive. But overall, after round one, I think we ended up being in a white space. Most of the competitors, I think 6 of 9, went towards a low-cost strategy. And so that ended up working out pretty well. We also realized that regardless of where we were on the SQ and models graph, we were going to have to be very good operationally. This was, one, in case somebody ended up near us in terms of positioning, we wanted to have a cost advantage, but also because looking at the way that the simulation was going to be graded, we realized that since image was only 4%, anywhere we were going to go, we were only going to be successful if we were able to have a high profit margin. And so we wanted to invest heavily in operations, both to decrease our cost per shoe as well as sort of to increase our total amount of capacity, so we kind of spread these fixed costs. And so in the mid game, we started having problems as teams from the bottom that had started initially with a low-cost strategy started to move upwards because of how competitive that particular segment of the market was. And so DeRoyce will talk about later how we ended up dealing with those people. But overall, we ended up being pretty successful, coming in at second because we were able to defend our white space sort of north of that midpoint that everybody started in.
Good morning and welcome to the Brown Shoe Company investment call. My name is DeRoy Simmons. I'm the CEO. Today we're going to kind of outline our strategy over the course of the simulation as well as some of our high moments. We'll also hear from our Chief Marketing Officer, our Chief Operations Officer, as well as my CFO, Minwon Kim. At the beginning, our strategy throughout the course of the simulation was to provide a highly differentiated product and try to capitalize on the cost within that premium shoe segment. And as CEO, I wanted to remain flexible. We initially made some soft commitments, but the long term was to remain flexible, but to pretty much crush our competition. So in doing that, when we look for white space, we provided a product with a higher price point, higher model numbers, as well as a higher SQ. And as we began to gain market share through our marketing efforts along with our operational efforts, which were done marvelously, we began to see some good returns. By the end of the simulation, we can look down at our earnings per share. They're at $10.31, was a industry high for industry 4, of course. Our return on equity was 27.4%, which I think returns a lot of dollars spent to our shareholders, and you should be pretty much happy. So is our stock price. We entered the game with the highest stock price within our industry at $170. With that said, we did not win industry 4. We lost by a point. And of course, if you don't come first, you come last. And so with that being said, I think we had a strong company that had a strong strategy of just differentiating our product. Now, throughout the course of the game, our finance guy, man, one, he'll talk a little bit about some of the loans that we took, some of the strategies that we used there. But for me, the cost was didn't really. I wanted to have the best cost, but at the end of the day, I just wanted to have the best product. And I realized from a operations standpoint and marketing standpoint, it's kind of how you position yourself amongst your competition. Therefore, I focus a lot on our competition. Initially, if we can look back at year 14, we saw the Happy company come within our white space. And so we used a few strategies by building up capacity, building up our model numbers, and then dropping our price sort of below theirs. And they had a lower SQ. And so they kind of hurt them in the long run. So we look next to around, the next year, 15, and we see improvement. Another competitor try to come into our differentiation, our premium segment. And again, we use the same strategy where we looked at their SQ, we looked at their model numbers. We knew we had a superior product, and yet we wanted to, again, drop our price and kind of show them, hey, you want to go somewhere else. So if we look at our overall strategy, we noticed that a lot of competitors in our industry went for what we call the Walmart, which is going to provide a lot of models at a low cost and a low price point. And so if we see a lot of the competition going to that area, of course, we're going to pivot and try to go as far up and to the right as possible if we're to look at a 4-quadrant map there. So that's exactly what we did. We saw another company, Comfort Shoes, completely change their strategy. And so they changed their strategy and actually was in a pretty well positioned through the simulation up until that last year, in which after we had picked off all the other competitors within our premium market, we went after them and we dominated them as well. The winner of our group was, of course, I wouldn't say it's the biggest, but it was the most efficient, low cost, low SQ, low price point firm within Industry 4, and that was the Duck Company. I believe with one or two more rounds, we would have dominated them as well because we have a superior product. Our costs were pretty much the best within the differentiation, the premium segment, and we were looking to dominate once again another competitor. However, we lost by 1 point again. So if we look at the overall strategy, again, we provided a premium product to the industry. We dominated in terms of endorsements as well. We had at least 5 endorsements, which you'll hear the chief marketing officer talk about. But our overall strategy was simply to provide a premium product and kind of differentiate on different means in terms of our marketing efforts and our operations. Again, I appreciate all the investors. As I said, one of my main goals as the CEO was to try to take a snapshot of the industry and come up with a strategy that still stayed on target with the premium segment, but crushed our other competitors. And I think we were quite successful from that point. We'll go ahead and move on and hear from our CFO and our COO and our marketing officer, and they can kind of go into the details of our strategy. But again, I'll be around for any questions after the investor call, and I look forward to hearing from you. Thank you.
My name is Mina Kim. I play the CFO role in this business simulation game. From now on, share our coordination problem or
Biases.
biases. Thank you. Regarding the biases, our COO, Barford, always played devil advocate, but really just wanted to spend more money on marketing. Droid, our CEO, he did not focus on number, just wanted to crush other teams at all cost. So he was always focused on market share and competitive advantage, but he didn't care much about the cost. As CFO, I focused on strengthening our cost structure. So I spent a lot of money into expand our capacity to increase our economy of scale by using a bunch of loan. But I didn't hesitate in using the loan. Look, as a CEO, wanted to spend a lot of time worrying about price. Luke was less concerned about the cost and margin, but thought that the shop price point was the most important thing. Overall, our team struggled staying focused early on, while we knew we wanted to move into the top right of the SQ and price versus models graph. We were not united on how to get there. We eventually decided to increase SQ early rather than the number of models, but there were many arguments about which was better. There was also a moment in the round when our pricing was off, where we almost decided to try and become Walmart.
Hi, my name is Andrew Barford. I am the Chief Marketing Officer for Brown Shoe Company in Industry 4. So when looking at the strategic pivots that we took throughout the simulation, we started off initially with a strategy to focus on a moderate to high SQ rating, as well as moderate to high number of models. We felt that this was going to help differentiate us and really kind of push us to success. To accomplish this, we focused on having operational efficiencies as well as a capacity advantage over our competitors. And initially, this was extremely successful for us. We started off pretty strong in the industry, but we found that with that success brought some competition, because everyone else started at the lower end with the lower SQ, a lower price, and a lower to moderate model number. But eventually that got crowded and people started moving up to our space. So we had Team H initially moved up and tried to encroach on our strategy, kind of trying to follow it. And in order to combat that, we pivoted by increasing our efficiencies again, as well as increasing our capacity in Latin America. And this really let us undercut H, both on price and as well as increase our volume and our market share. And it really helped drive them out of the market and led us to be successful there. Then secondly, we had I, who moved up from the low-cost, low SQ, positioning. And, in order to combat them, we increased our capacity again in Latin America. But also at this time, we decided we needed to increase our model number. So we went from, I believe, 250 to 350 at this point. And that really helped kind of continue to help differentiate us from them. And then we also lowered our prices, which helped us continue to undercut them. And it really kind of helped stabilize our position in that moderate to high quality with a large number of models. It was at this point that we faced our largest challenge, which was from Team C. They started off initially with a different strategy, but very quickly they found a very similar strategy to us, and they were the most difficult for us to compete with because they also had invested in operational efficiencies. But we had a capacity advantage against them, and it really kind of allowed us to utilize volume against them. And so we increased our models to 500. We maintained that for the last 2 rounds of the simulation. And it really allowed us over those 2 rounds to gain the advantage and eventually beat C out in the final round. Just looking back, the only changes that I think that we would make differently was kind of the timing of our investments and capacity. We made some maybe ill-timed investments in trying to move too quickly in our capacity, and I think that maybe waiting and really timing the market a little bit better would have been more efficient with our money. But we knew that at the time we needed to compete against E and D, who were investing heavily in capacity and efficiencies, and we thought that eventually that the lower end of the market was going to move up and start to encroach on our higher brand awareness portion.